Something happened in the Persian Gulf last week that the mainstream media covered for exactly one news cycle and then moved on. But the quiet investor doesn't move on, because what happened in those waters has implications for your portfolio, your purchasing power, and the global financial order that will echo for years. On March 3rd, 2026, the USS Dwight D. Eisenhower Carrier Strike Group, one of the most powerful naval formations in human history, repositioned approximately 1,000 kilometers south from its operational station in the Strait of Hormuz to a defensive posture in the Arabian Sea. The Pentagon called it a routine operational adjustment. The media called it a strategic redeployment. But the intelligence community and every oil trader on the planet knows exactly what it was. It was a retreat. The first time in over 4 decades that an American carrier strike group has been effectively pushed out of its forward position in the Persian Gulf by a regional power's threat capability. Iran didn't fire a single shot. They didn't need to. Their advanced anti-ship ballistic missiles, their drone swarm technology, and their network of proxy forces across Iraq, Yemen, and Lebanon created a threat environment so dense that the United States Navy concluded the risk to a $13 billion aircraft carrier and its 5,000 crew members was no longer acceptable. Now, most people will hear this and think it's a military story. It's not. This is a financial story. And by the end of this video, you will understand exactly why a carrier retreating 1,000 kilometers in the Persian Gulf could be the single most important signal for your money in 2026. I'm going to walk you through what happened, why it matters for oil markets, how it connects to the petrodollar system we've discussed in previous videos, and the 4 strategic moves the quiet investor is making right now in response. No panic, no politics, just the financial reality. Let's break it down. To understand why a carrier repositioning matters for your money, you need to understand the financial architecture that depends on American military dominance in the Persian Gulf, because this is not just about ships and missiles. This is about the foundation upon which the entire dollar-based global financial system rests. Approximately 21% of the world's daily oil consumption passes through the Strait of Hormuz. That is roughly 21 million barrels per day. Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, and Qatar all export the majority of their crude oil through this narrow waterway, which is only 33 kilometers wide at its narrowest point. For over 40 years, the United States Navy has maintained a permanent carrier presence in the Persian Gulf for one primary reason: to guarantee the free flow of oil through the Strait of Hormuz. This guarantee is not just a military commitment, it is a financial commitment. It is the physical enforcement mechanism behind the petrodollar system. As we discussed in a previous video, the petrodollar arrangement established between the United States and Saudi Arabia in 1974 ensures that global oil trade is denominated in dollars. In exchange, the United States provides military protection for Gulf oil producers and guarantees the security of shipping lanes. This arrangement has given the United States an extraordinary economic advantage. Global demand for dollars to purchase oil has allowed America to run massive deficits, borrow at artificially low interest rates, and maintain a standard of living subsidized by the dollar's reserve currency status. But here is the critical insight that most people miss. The petrodollar system doesn't work on trust alone. It works because of the implicit threat of American military force. The Gulf states price oil in dollars because America guarantees their security. Other nations accept dollars for oil because America controls the shipping lanes through which that oil flows. Remove the military guarantee and the entire financial architecture becomes unstable. Not overnight, but gradually and then suddenly, as every reserve currency transition in history has demonstrated. And what happened on March 3rd is the first visible crack in that military guarantee. Let me be precise about the sequence of events, because precision matters and the details tell a much more significant story than the headlines suggest. In late February 2026, Iran conducted what military analysts described as the most sophisticated integrated air defense and anti-access area denial exercise in its history. Over a 72-hour period, Iran simultaneously tested its Fatah-2 hypersonic ballistic missile, capable of reaching speeds exceeding Mach 13 with a range of 1,400 kilometers. It deployed swarms of over 200 Shahed series drones in coordinated attack patterns over the Gulf waters. It activated its Bavar 373 advanced air defense system along the entire southern coastline, and it moved dozens of fast attack boats equipped with anti-ship missiles into forward positions near the Strait of Hormuz. The exercise was clearly designed to demonstrate a single capability: the ability to deny access to the Persian Gulf to any naval force, including an American carrier strike group. Now here is what makes this different from Iran's previous military posturing. In the past, Iran's threats were largely bluster. Their missile technology was inaccurate. Their drones were primitive. Their air defenses were outdated Soviet-era systems. The United States carrier group could operate with relative confidence that its layered defensive systems, its Aegis combat ships, its fighter aircraft, and its electronic warfare capabilities could neutralize any Iranian threat. That calculus has fundamentally changed. And the reason it has changed comes down to three technological developments. First, Iran's hypersonic missile capability. The Fateh-2 travels at speeds that make it extremely difficult for current shipboard defense systems to intercept. At Mach 13, the missile covers 1,000 kilometers in under 5 minutes. The reaction time available to a carrier's defensive systems is measured in seconds. Military analysts have publicly questioned whether the Aegis system can reliably intercept a coordinated salvo of hypersonic missiles. Second, Iran's drone swarm technology. The Shahed drones that Iran has been refining through their deployment in the Ukraine conflict have become significantly more sophisticated. They can now operate in coordinated swarms of hundreds, overwhelming defensive systems through sheer volume. Each drone costs a fraction of the interceptor missiles used to shoot it down, creating an economic asymmetry that favors the attacker. Third, Iran's integrated command and control network. Iran has built a distributed network of launch sites, radar installations, and communication systems across its southern coast, its islands in the Persian Gulf, and through its proxy forces in Iraq and Yemen. This means a threat can come from multiple directions simultaneously, making it exponentially harder for a carrier group to defend itself. The combination of these three capabilities created a threat environment that military planners call an Anti-Access Area Denial Zone, or A2AD. And for the first time, Iran's A2AD capability is credible enough that the United States Navy concluded it was prudent to move its most valuable asset, a nuclear-powered aircraft carrier, out of range. The Pentagon will never publicly admit this was a retreat, but the repositioning speaks for itself. The carrier moved from a forward position inside the Gulf to a defensive position over 1,000 kilometers away in the Arabian Sea. That is not a routine adjustment. That is a strategic withdrawal from a contested space. Now, let me translate this military development into financial language, because this is where it directly impacts your money. The moment the carrier repositioned, oil futures spiked. Brent crude jumped $7 per barrel in a single trading session, briefly touching $94 before settling around $91. The spike was driven by a single realization that rippled through every trading desk on the planet. If the United States cannot guarantee safe passage through the Strait of Hormuz, the risk premium on every barrel of oil that transits those waters increases permanently. Let me put numbers to this. Before this event, the geopolitical risk premium embedded in oil prices was estimated at approximately $5 to $8 per barrel. Analysts at Goldman Sachs, JP Morgan, and several independent energy consultancies have now revised that estimate to $12 to $80 per barrel. That means every barrel of oil the world consumes is now $7 to $10 more expensive, not because of supply and demand fundamentals, but because of the increased risk that the world's most critical shipping lane could be disrupted. And here is where it connects to your daily life. Higher oil prices flow through the entire economy. They increase transportation costs, which increases the price of everything that gets shipped, which is everything. They increase the cost of manufacturing, because petrochemicals are inputs in virtually every industrial process. They increase the cost of food, because modern agriculture is entirely dependent on diesel fuel and petroleum-based fertilizers. In short, a $10 per barrel increase in the geopolitical risk premium on oil is an inflationary shock that hits every consumer in every developed economy. But the oil price impact is only the first-order effect. The second-order effect is far more significant. If the United States cannot militarily guarantee the free flow of oil through the Strait of Hormuz, the foundational premise of the petrodollar system is undermined. Why would Saudi Arabia continue to price oil exclusively in dollars if the American security guarantee is no longer credible? Why would Gulf states continue to recycle their oil revenues into United States Treasury bonds if America cannot protect their shipping lanes? The answer is they wouldn't, and they're already starting to diversify. As we discussed in our first video, China has established a gold-backed yuan oil settlement mechanism through the Shanghai International Energy Exchange. Saudi Arabia has been in negotiations with Beijing about pricing a portion of its oil exports in yuan. The Gulf Cooperation Council has been steadily increasing its gold reserves and diversifying its sovereign wealth fund allocations away from dollar assets. The carrier retreat accelerates all of these trends. It provides a concrete, visible justification for Gulf states to reduce their dependence on American security guarantees and, by extension, on the dollar-based financial system. This is the signal that the quiet investor watches, not the headline, not the military analysis, but the financial consequence. And the financial consequence of this event is a measurable acceleration in the de-dollarization trend that has been building for years. Let me give you two historical parallels that illuminate why military retreats from strategic waterways have profound financial consequences. The first is the Suez Crisis of 1956, when Egyptian President Gamal Abdel Nasser nationalized the Suez Canal, Britain and France. The colonial powers that had controlled the canal launched a military intervention to retake it. The United States, under President Eisenhower, opposed the intervention and threatened economic consequences. Britain, already weakened by World War II debt, was forced to withdraw. The financial consequences were immediate and devastating. The British pound, which had been the world's primary reserve currency for over a century, suffered a crisis of confidence. Capital fled London, sterling was devalued, and within a decade, the dollar had fully replaced the pound as the world's dominant reserve currency. The lesson is clear. When a global power demonstrates that it cannot or will not project military force to protect critical trade routes, the financial system built on that power's currency begins to unravel. The second parallel is the decline of the Spanish Empire in the 17th century. Spain's economic dominance was built on its control of Atlantic trade routes and its access to gold and silver from the Americas. When the Dutch and English navies began successfully challenging Spanish naval supremacy, the flow of precious metals became unreliable, confidence in the Spanish real declined, and Spain entered a prolonged period of economic and monetary decline. The pattern repeats throughout history. Military power projection underpins monetary dominance. When the military projection weakens, the monetary dominance follows. Not immediately, but inevitably. The carrier retreat in the Persian Gulf is not the end of American military dominance, but it is a signal, a clear, measurable signal, that the era of uncontested American naval supremacy in the world's most critical energy corridor is ending, and the financial implications of that shift are enormous. Here is my honest assessment, and I want to be balanced because this is a topic where emotions run high and nuance gets lost. I do not believe the United States is finished as a military power. The U.S. Navy remains the most capable naval force on the planet by a significant margin. The defense budget exceeds $900 billion, and the technological capability of American forces is still unmatched in most domains. But I do believe that the era of cost-free military dominance in the Persian Gulf is over. The threat environment has evolved to a point where forward deployment of carrier groups carries meaningful risk for the first time since the 1980s, and that change in risk calculus has direct financial consequences. The carrier is not gone, but its position has changed. And in geopolitics, as in investing, positioning is everything. The quiet investor doesn't take sides in political or military debates. The quiet investor reads the signal and positions accordingly. And the signal from the Persian Gulf is that the military foundation of the petrodollar system is weakening, not collapsing, weakening. And weakening foundations require portfolio adjustments. So here are the 4 strategic moves I believe every investor should consider in light of this development. The first move is to increase your energy exposure. If the geopolitical risk premium on oil is structurally higher, energy companies benefit directly. Producers with long life reserves, low production costs, and strong balance sheets will generate higher cash flows for longer than the market currently prices. Integrated oil majors, upstream producers in stable jurisdictions like the Permian Basin and the Canadian oil sands, and energy infrastructure companies that own pipelines and export terminals all benefit from elevated oil prices. Additionally, consider energy royalty trusts and master limited partnerships that pass through cash flow directly to investors. In a world where oil carries a permanent $10 to $15 geopolitical risk premium, these cash flow generating assets become significantly more valuable. The second move is to accelerate your precious metals allocation. Every escalation in geopolitical tension reinforces the case for gold. Central banks in the Middle East and Asia will accelerate their gold purchases in response to the perceived weakening of the American security umbrella. Physical gold demand from sovereign buyers provides a structural floor under prices. If you followed the recommendation from our previous video on gold at $3,500, you already have a 10% to 15% allocation. In light of this development, consider increasing to 15% to 20% if your risk tolerance allows. Silver continues to offer leveraged upside with the gold to silver ratio still elevated above 80 to 1. Physical metal remains the priority, held outside the banking system under your direct control. This is the asset that performs when everything else you trust starts to crack. The third move is to hedge against inflation. The oil price shock we're seeing will feed through to consumer prices over the next 3 to 6 months. This makes inflation-protected assets more valuable. Treasury inflation-protected securities, or TIPS, adjust their principal based on CPI changes. I-bonds from Treasury Direct offer inflation-adjusted returns with government backing. Commodities broadly, including agricultural commodities, industrial metals, and energy, tend to outperform during inflationary periods. Real estate with pricing power, particularly properties with short-term leases that can adjust rents upward, also provides a hedge. Think self-storage facilities, apartment buildings in supply-constrained markets, and commercial properties with percentage rent clauses tied to tenant revenue. The key is to avoid long-duration fixed-income assets. A 20-year bond paying 4.5% is a terrible investment if inflation runs at 5% to 7% for the next several years. You're locking in a guaranteed loss of purchasing power. Shorten your duration. Increase your inflation sensitivity and position for a world where energy costs remain elevated. The fourth move is to diversify geographically. If American military dominance in the Gulf is diminishing, the countries that benefit are those with independent energy security and those positioned to profit from a multipolar world. Norway, with its sovereign wealth fund and North Sea energy production. Australia, with its LNG exports to Asia. Brazil, with its deepwater pre-salt oil reserves. Canada, with its oil sands and political stability. Allocating a portion of your equity portfolio to these commodity-rich, politically stable nations reduces your dependence on American military and monetary hegemony. It is not about abandoning America. It is about acknowledging that the world is changing and positioning your portfolio to benefit from that change, rather than be victimized by it. Here are the 4 indicators I'm monitoring to gauge how this situation evolves. First, watch the carrier strike group positioning. If the USS Eisenhower remains in the Arabian Sea and is not redeployed forward into the Gulf within the next 60 days, it confirms that the withdrawal is strategic, not temporary. Track naval deployment updates through open-source intelligence platforms. Second, watch Brent crude oil prices. If oil sustains above $90 per barrel for more than 30 consecutive trading days, the geopolitical risk premium has become structural. This will have cascading effects on inflation, corporate margins, and consumer spending. Third, watch Saudi Arabia's diplomatic moves. Any expansion of the Saudi-China energy partnership, any announcement about yuan-denominated oil sales, or any reduction in Saudi purchases of U.S. treasuries would confirm that the security for dollars arrangement is fraying. Fourth, watch gold. If gold breaks above $3,700 in the weeks following this event, it confirms that sovereign buyers are accelerating their diversification away from dollar assets in response to the perceived weakening of American military guarantees. Gold is the ultimate barometer of confidence in the existing financial order. I'll be tracking all 4 of these indicators and updating you as the situation develops. Here's the question I want you to answer in the comments, and I'm genuinely interested in your perspective. Do you believe the United States can maintain its military dominance in the Persian Gulf? And more importantly, do you think the petrodollar system survives the next decade if that dominance weakens? This is not a political question. This is a financial question. And how you answer it should directly influence how you allocate your portfolio. I read every comment on this channel. The discussions in this community are consistently among the most informed and thoughtful I've found anywhere. And your perspective on this topic, whether you agree with my analysis or disagree, helps all of us think more clearly about the risks and opportunities ahead. If this video helped you see a military headline through a financial lens, if it helped you understand why a carrier repositioning 1,000 kilometers matters more for your money than any earnings report or jobs number, then I need 2 things from you. First, subscribe and turn on notifications. The situation in the Gulf is evolving rapidly, and I will be here to break down every major development with the same depth and balance you got today. This is a story that will unfold over months, not days, and the quiet investor stays informed through every phase. Second, share this video with someone who thinks military news doesn't affect their portfolio, because by the time they realize it does, the market will have already priced in the consequences, and the quiet investor is always positioned before the crowd even understands what's happening. The Gulf has shifted. The signal is clear. The only question is whether you'll position before the crowd or react after the move has already been made. Stay quiet, stay informed, stay invested. I'll see you in the next one.